Welcome back to the channel. Today we've got a huge market update from one of Wall Street's most reliable bulls, Tom Lee, co-founder and head of research at Fundstrat. In his latest appearance on CNBC's Squawk Box, he made a bold prediction. Expect the S&P 500 to reach new all-time highs in August. That's right, while most investors are still worrying about a potential slowdown, Tom Lee is calling for a rally this month. He also weighed in on inflation, the Fed's next move, and some very interesting developments at 𝗣𝗟𝗏, a company making big waves in the crypto space. In just a moment, I'll play the full clip of Tom Lee's appearance so you can hear it directly. Then, I'll jump in with my full reaction and breakdown, what I agree with, what I'm cautious about, and what it could mean for your portfolio. And stick around because right after that, I'll share my in-depth analysis of two cheap AI stocks I believe are seriously undervalued right now, and could be poised to benefit from the same bullish setup Tom is talking about. If you're only going to watch one video today, make it this one. Hit that like button. Let's try to get this video to 1,000 likes. Drop your thoughts in the comments. I want to hear if you agree with Tom Lee's outlook. And don't forget to subscribe so you never miss the next big financial update. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. All right, let's hear what Tom Lee had to say.
Tom Lee, head of research at Fundstrat, chief investment officer of Fundstrat Capital. He's also the chairman of 𝗣𝗟𝗏 as well. As a CNBC contributor, we've got some new stuff to factor into your either bearish or bullish case. I assume it's still somewhat bullish, but okay, the economy looks like it may actually be slowing a little bit. Last week, the markets definitely retrenched. You've been solidly bullish since, Liberation Day. But last week was a setback, and August is not always a great month. You think we get a little bit of choppiness here? Are you still bullish?
Well, last week was definitely consolidation because we had 5 days where the market opened higher and closed lower.
Really?
And they call that bearish engulfing. It makes sense because we're consolidating that 28% gain from the April lows. And on the job stuff, I think it's just the data's catching up to what we already know. The labor market's been soft, right? So it's, I think, a positive setup because now the Fed has more ammunition to make a dovish pivot in the fall. And it's not too late because we know the thing that they're going to stimulate is the housing market. And you had a couple guests earlier talking about that. And so that is what strengthens the economy in 2026. So I think it's quite a positive setup. We're just consolidating and then we make a bigger move higher.
Is it fair to say that since it's a dual mandate, that maybe the Fed should have been able to think that there was more risk to a slowdown than to inflation? Do you think they missed that a little bit and they're fighting? I don't know, but Trump said you got to cut, so they couldn't. Maybe they had to err that way just for political reasons.
Yeah, I think the Fed needs to demonstrate independence, but you're right. I think when they look at their dual mandate, they're probably drifting further from the employment metric now because the unemployment rate, if you use the existing participation rate before this report, it's almost 5% now. So the Fed now has to be considering the risk of jobs market actually going into a cycle of weakening.
Right, but you have also been, I guess dovish is the word, on inflation. You have not thought that there is going to be necessarily a big impact from the tariff regime.
That's right. And I think the biggest takeaway is, first of all, if you look at the latest inflation report, the goods component that are tariff-driven, it's been only mild. But also, if you use the same inflation measure Europe uses, which is inflation ex housing, we're actually under 2%. The Fed, if they were the ECB, would be cutting right now.
That's interesting. So by the end of the year, or what target are you using now, and what time frame?
I think we're going to rally pretty strongly in August. So I think we can get back to 65 or get to 65, 6,600 all-time highs in the next couple weeks.
And then 7,000 in the next 12 months, above that?
Yeah, probably well above that.
Well above that.
Yeah.
𝗣𝗟𝗏, we mentioned that at the top, is going to be, in your view, the micro strategy or strategy of Ethereum or Ether.
Yes, that's right. Just a month ago, I was on the show to announce I was becoming chairman. And at the time, the stock was $4.50, and we announced a $250 million investment led by Founders Fund and 𝗗𝗟𝗗𝗧 and others. But today we announced that we reached almost $3 billion worth of ETH. And
the largest ETH holder then.
Yeah, the largest ETH treasury in the world and the third largest crypto treasury in the world. And we also announced that Bill Miller III made a major investment last week into Bitmain. So that he joins Cathie Woods in investing in our company in the past couple weeks.
That's the Bill Miller from Legg Mason we all know.
Yes,
right?
that's right. The Bill Miller that we all know.
Yep.
Yes.
He was super early.
Yeah.
On crypto too.
No, that's what I was saying. Super. He was like, right? What was he getting in Bitcoin at? 2012, 13?
Yeah, he has some of the lowest cost Bitcoin out there.
What's your symbol? What is Bitmain?
It's ticker BMNR. And the stock now is around 32. So in the past $4.50, yeah.
Tom kicked off the interview by addressing the recent pullback in the markets. Now, if you've been watching the S&P or NASDAQ over the past couple of weeks, you probably noticed it too. A string of down days where the market opened higher and closed lower. Lee calls this a bearish engulfing pattern, which sounds ominous, but in his view it's more of a natural breather than a red flag. He pointed out that we're still up 28% from the April lows, so this isn't a crash, it's consolidation. Translation? The market's taking a pit stop after a strong rally. And historically, August is notoriously sluggish. He's not shaken at all. In fact, he sees this as a setup for another leg higher. What stood out here is Tom's optimism in the face of short-term weakness. He's basically saying, don't confuse a pause with a reversal. If you're a long-term investor, his message is clear. Stay the course. Now let's talk about the labor market. One of the core themes in this interview. Tom believes that the current jobs data is finally starting to reflect the softness we've already known about. That's a key point. The Fed, which has been hyper-focused on inflation, now has a fresh reason to consider pivoting. Employment. He brought up something really interesting. If we adjusted for labor force participation, the real unemployment rate might already be closer to 5%. That's significantly above headline numbers. If that's true, and if the Fed acknowledges it, it gives them the green light to start cutting rates sooner rather than later. Tom sees this as ammunition for a dovish pivot. He's implying that the Fed has to shift its stance soon because the jobs picture is deteriorating, and with the election season heating up, the pressure's on. So for retail investors watching the Fed like a hawk, here's the key takeaway. Rate cuts could come quicker than most expect, and that's bullish for equities and risk assets. On inflation, Tom continues to lean dovish. He made it clear that despite all the noise around tariffs and goods prices, the actual inflationary pressure from tariffs has been mild. That's something most people overlook, and it matters. He even pointed out that if the US used Europe's inflation metric, which strips out housing, our inflation would actually be under 2%. That's below the Fed's target. And in Europe, if inflation were this low, central banks would already be cutting rates. It's a subtle jab at the Fed's approach, suggesting they might be late to pivot, even though the data already supports it. So again, if you're wondering whether the Fed still has reason to wait, Tom says not really. Inflation, especially on the goods side, isn't an issue anymore. In fact, monetary policy may already be too tight given where the data stands. Here's where Tom really doubled down on his bullishness. Despite the pullback, he thinks the market is setting up for a strong rally in August, with a potential move to 6,500 or 6,600 on the S&P in just the next few weeks. That would be a major new all-time high, and if that plays out, he sees the index climbing well above 7,000 within the next 12 months. That's a bold call, especially with so much macro uncertainty out there. But Tom isn't hedging. He's making it clear. The backdrop supports higher asset prices, not lower. He's basically saying, this is a bullish cycle that's still early, not late. Now here's the part where Tom shifted gears, and it's something the crypto crowd will love. He talked about his role as chairman of Bitmain, not to be confused with the Chinese mining company. This is a crypto-native Ethereum holding firm. He likened it to the MicroStrategy of ETH, which is a huge claim. Just a month ago, they announced a $250 million investment, led by big names like Founders Fund. Since then, they've amassed nearly $3 billion in ETH, making Bitmain the largest Ethereum treasury in the world, and the third largest crypto treasury overall. What's more, legendary investor Bill Miller III, known for his early bets on Bitcoin and value stocks, recently took a significant position in the company. He joins Cathie Wood, who's already invested. That's not just noise. That's real institutional interest. So here's the bigger picture Tom's painting. Ethereum could see the same kind of institutional adoption that Bitcoin did in the last cycle, and Bitmain wants to be the gateway for that, holding massive ETH reserves in a publicly listed structure. For crypto bulls, this is a massive validation. And it's a hint that ETH might be ready for its own breakout narrative, especially as ETFs, staking, and tokenization gain momentum. To wrap this all up, Tom Lee's interview wasn't just another segment about market noise, it was a macro roadmap laced with conviction. He's telling us, the market's consolidating, not collapsing. The Fed has more reasons to cut than to hike. Inflation is not as sticky as people think. A massive rally could be brewing. And Ethereum might be on the brink of institutional FOMO. Whether or not you agree with all of it, you can't deny the consistency in his outlook, and the fact that he's often gotten the timing right. So now it's your move. Are you positioning yourself for a second-half rally? Are you watching ETH's next breakout? Or are you still waiting on the sidelines? Let me know in the comments what you think about Tom Lee's take, and whether you're riding with him on this next market leg. If you found this breakdown helpful, make sure to hit that like button, subscribe for more weekly deep dives. Now it's time to break down the two cheap artificial intelligence stocks that I believe are seriously undervalued at the moment. Let's start with a company that's not just a player, but the backbone of the entire AI hardware revolution, ASML. If you've ever marveled at the power of modern artificial intelligence, you're really marveling at the invisible infrastructure that makes it all possible. And at the very heart of that infrastructure is ASML, a company that's quietly become one of the most important in the world. Now, ASML doesn't actually make AI chips themselves. Instead, they make the machines, the ultra-advanced, mind-bogglingly complex machines that make those chips possible. Think of them as the master toolmaker in a world where the tools themselves are worth billions. Every major chip maker on the planet, TSMC, Samsung, Intel, and many more, relies on ASML's unique technology. If you've ever used a smartphone, a laptop, or even a smart appliance, you've indirectly benefited from ASML's innovations. Their secret weapon? Extreme ultraviolet or EUV lithography. This is the only technology on Earth capable of etching the tiniest, most advanced transistors onto silicon wafers. It's a process so precise it operates at the atomic level, and it's the key to making the world's fastest, most efficient AI chips. Without ASML, the entire global supply of cutting-edge AI chips would grind to a halt. There's simply no alternative. If ASML stopped shipping machines tomorrow, the world's most advanced chip fabs would be stuck in the past. Their EUV machines are true engineering marvels. Each one costs around $200 million, weighs more than a Boeing 747 at 180 tons, and is assembled from over 100,000 parts sourced from hundreds of suppliers. The precision required is so extreme that even the tiniest vibration can throw off the process. This didn't happen overnight. Decades of relentless research and development and billions of euros invested have built a technological moat so wide and deep that no competitor has even come close. ASML's lead is measured not in years, but in decades. The result? ASML owns 100% of the EUV lithography market. That's not just dominance, it's a true monopoly in a technology that's absolutely mission-critical for the future of AI, computing, and beyond. So why is ASML such a powerful AI play? Because every leap forward in artificial intelligence, every new breakthrough, every faster model, every smarter device, demands more powerful chips. And every one of those chips, at the bleeding edge, is made possible by ASML's machines. As the demand for AI explodes, ASML sits at the very source, collecting a toll on every single advancement. It's like owning the only bridge into a gold mine. Every miner has to pay you to cross. Of course, the stock can be volatile. The semiconductor industry is famously cyclical, with booms and busts. But that's just short-term noise. The long-term story is all about structural growth. The demand for advanced chips is only accelerating, driven by AI, cloud computing, the Internet of Things, autonomous vehicles, and more. Every new wave of technology needs more chips, and every chip needs ASML. ASML is projecting strong revenue growth for years to come, as new chip fabs are being built all over the world. Each one of these multi-billion-dollar factories needs ASML's machines to even get started. Financially, ASML is a juggernaut. They boast high margins, consistent profits, and a mountain of free cash flow. Their financial statements read like a textbook example of a world-class business, and they don't just hoard their cash, they reward shareholders with regular dividends and aggressive share buybacks, steadily increasing the value for long-term investors. Their balance sheet is rock solid, with manageable debt levels and a huge backlog of orders that stretches years into the future. This isn't a company living quarter to quarter, they're planning decades ahead. With a market cap sitting at just over $270 billion, ASML continues to deliver on both performance and potential. The company's earnings per share stand at 24 euros 3 cents, and it's trading at a PE ratio of 25, which, given its industry position, still looks reasonable to many analysts. Now here's where things get interesting. Despite strong fundamentals, ASML's current stock price of $697.58 is trading about 42% below its estimated fair value of $992.58. That disconnect is turning heads. A lot of investors are beginning to view the recent weakness in the stock as a rare buying opportunity. Part of that optimism comes from the strength in its Q2 2025 results, which beat expectations on both revenue and profits. The company posted revenue of €28.26 billion, and net income hit €7.57 billion. Perhaps more importantly, gross margins came in above 53%, which reinforces just how efficiently this company is operating, even in a volatile market. And of course, there's the AI boom. ASML plays a foundational role in the semiconductor technology that powers advanced AI systems. As demand for AI infrastructure continues to surge, ASML is uniquely positioned to benefit. Analysts watching the AI space closely are seeing ASML not just as a chip manufacturer, but as a crucial enabler of the next wave of tech innovation. This isn't some speculative tech bet. This is a dominant, well-managed business with a proven track record and a clear vision for the future. When you buy ASML, you're not just betting on one chip maker, you're betting on the entire AI chip industry. It's a way to own the picks and shovels in the greatest technological gold rush of our time. Remember the gold rush? You could gamble on a miner, or you could sell the picks and shovels. ASML is selling the shovels, at a premium with a line of customers out the door. And it's not just private industry. Governments around the world are pouring billions into domestic chip manufacturing, recognizing that semiconductors are now a matter of national security. The US, Europe, China, and others are all racing to build new fabs. Every single one of these new factories needs ASML's machines. That makes ASML the biggest beneficiary of this global arms race for chip supremacy. Some investors worry about valuation, but let's be clear, ASML is a high-growth tech monopoly. Its premium price is justified by its unique position and the sheer scale of its opportunity. Of course, there are risks. A global recession or major supply chain disruption could slow orders, but ASML's geographic diversity, deep relationships, and essential role in the industry give it resilience that few companies can match. The long-term trend toward more powerful AI and more advanced chips is simply too powerful to ignore. The world is only going to need more of what ASML provides. To recap, ASML is a monopoly in a mission-critical technology, with massive AI tailwinds, fortress-like financials, and a stock that's trading at a discount because of short-term fears. This is the kind of opportunity that doesn't come around often. This is a classic buy-and-hold compounder. If Warren Buffett focused on tech, ASML would be at the top of his list. It's the kind of business you can own for decades and sleep well at night. The company's moat is unbreachable, and its business model is like a toll road on the most important industry of our time. Every new advance in AI, every new chip, every new device, ASML gets paid. Right now, the market is giving us a rare chance to buy this digital king at a fair price. For long-term investors, opportunities like this are gold. But don't just take my word for it. Dig into their investor materials, read their annual reports, and see for yourself how dominant this business really is. The more you learn, the more you'll realize just how strategically important ASML is, not just for investors but for the entire future of technology. This isn't just a stock, it's a piece of the world's future infrastructure. Owning ASML is like owning a slice of tomorrow's digital economy. Getting in before the next big AI wave could be a game-changing investment. The next decade will be defined by companies like ASML. If you want to learn how to spot companies like ASML, businesses with real moats, real growth, and real staying power, check out my Value Stocks Investing Master Course. It's designed to help you identify great businesses, make smart decisions, and build lasting wealth for yourself and your family. Click the link in the description to get started on your investing journey. Now let's move to our second company, a household name with underestimated AI power. The story only gets more interesting from here. Our second pick is a name everyone knows, Alphabet, the parent company of Google and one of the most influential tech giants on the planet. While most people associate Alphabet with its search engine, the company is so much more than that. It's a sprawling empire of innovation, quietly shaping the future of technology in ways that touch billions of lives every day. While chipmakers and hardware companies often get the AI spotlight, Alphabet has been a true AI pioneer for well over a decade. Behind the scenes, its teams of engineers and researchers have been pushing the boundaries of what artificial intelligence can do, long before the current AI boom captured the world's attention. Think about it. Google Search, Maps, YouTube, Gmail, and Photos, all of these services are powered by advanced AI algorithms. Every time you get a smart reply in Gmail, a recommended video on YouTube, or a perfectly organized photo album, that's Alphabet's AI at work, making your digital life easier and more intuitive. Their secret weapon? Data. No one on Earth has more data than Alphabet, and in the world of AI, data is the ultimate fuel. Every search query, every map route, every video watched, these are all data points that feed and refine Alphabet's machine learning models, giving them an edge that's almost impossible to replicate. Every search, every video, every question you ask Google makes their AI smarter. This creates a self-reinforcing advantage. The more people use Google's products, the better their AI becomes, which in turn attracts even more users. It's a virtuous cycle that keeps Alphabet at the forefront of the digital world. Alphabet's DeepMind lab is behind some of the most jaw-dropping breakthroughs in AI, like AlphaGo, which defeated the world champion at the ancient game of Go, a feat once thought impossible for a machine. Now DeepMind is rolling out Gemini, a next-generation AI model that can understand and generate text, images, audio, and video, all in one seamless system. This technology isn't just for research labs. It's about to drive the next wave of AI-powered assistants, creative tools, and productivity apps that will change how we work, create, and interact with information. Imagine smarter virtual assistants, AI-powered design tools, and new ways to collaborate, all built on Alphabet's AI foundation. Yet despite all this innovation, the market still mostly values Alphabet as an advertising company. Investors often overlook the company's massive investments in AI and cloud computing, focusing instead on its dominant ad business. But that's starting to change, as the true scale of Alphabet's AI ambitions becomes clear. Google Cloud is a perfect example. It's now the third largest cloud provider in the world, right behind AWS and Microsoft Azure. But what sets Google Cloud apart is its deep integration with Alphabet's AI technology, making it the go-to platform for companies that want to build the next generation of AI-powered applications. And then there's other bets, Alphabet's portfolio of moonshot projects. Take Waymo, their self-driving car division. If autonomous vehicles become mainstream, Waymo could be worth tens of billions on its own, opening up entirely new markets for Alphabet. Right now, when you buy Alphabet stock, you're not just getting Google search and YouTube. You're also getting a stake in these high-upside moonshots, self-driving cars, life sciences, smart cities, and more, essentially for free. Despite all this, Alphabet trades at a forward PE ratio that's right in line with the S&P 500. That's remarkably cheap for a company with this much dominance, growth potential, and optionality. It's rare to find a business with such a wide moat trading at such a reasonable valuation. Alphabet's balance sheet is a fortress. With over $100 billion in cash and short-term investments, the company has the flexibility to invest aggressively in research and development, make strategic acquisitions, and buy back shares to reward shareholders. In fact, management has been buying back shares at a rapid pace, signaling their confidence in the company's long-term value. This not only boosts earnings per share, but also shows that Alphabet's leadership believes the stock is undervalued. Of course, there are risks. The biggest is competition in AI-powered search. When Microsoft integrated ChatGPT into Bing, many thought Google's dominance would be threatened. But in reality, Google's market share barely budged, proving the strength of its brand and technology. Google isn't standing still. It's rapidly integrating its own generative AI into search, making results more helpful, conversational, and personalized. This keeps Google ahead of the curve and ensures it remains the default choice for billions of users. Running generative AI search at scale is incredibly expensive, but Google has a secret weapon: its custom AI chips and world-class infrastructure. These give it a massive cost and performance advantage over would-be competitors, raising the barrier to entry even higher. Google Cloud is another underappreciated growth engine. As more companies race to adopt AI, they need cloud platforms that are AI-ready, and Google is perfectly positioned to capture this demand, thanks to its deep expertise in both cloud and artificial intelligence. Every dollar that moves to the cloud is high-margin, recurring revenue for Alphabet. This shift is transforming the company's business model, making its earnings more stable and predictable over time. When you invest in Alphabet, you're getting a cash cow search monopoly, a fast-growing cloud business, world-class AI research, and the upside of moonshot projects, all under one roof. It's a rare combination that's hard to find anywhere else in the market. All this comes with a pristine balance sheet and a valuation that doesn't reflect the company's true potential. The market is still catching up to the reality of what Alphabet has built. AI is not just another tech trend, it's a fundamental platform shift like the internet or the smartphone. And Alphabet is at the very center of this shift, with the data, talent, and capital to win the AI race. The market's short-term worries about regulation, competition, or economic cycles are creating a long-term buying opportunity for patient investors who can see the bigger picture. Most people see Google and think search engine. But savvy investors should see Alphabet and think AI conglomerate, a company with its hands in every major technological shift of the next decade. With a market cap of $2.37 trillion, it's one of the heaviest hitters in the market. In 2024, Alphabet reported $350 billion in revenue and over $100 billion in net income, driven by strong advertising performance and expansion in AI-related products and services. Just this week, Alphabet made headlines by partnering with U.S. electric utilities to cut power usage at its AI data centers during peak demand periods. It's a smart move, not just from an energy standpoint but also in terms of long-term cost management and public perception. In a time when AI is criticized for being power-hungry, Google is positioning itself as a sustainable leader in the space. Financially, they're still firing on all cylinders. In the most recent quarter, revenue grew by 14%, while earnings per share jumped 22%. That kind of growth, at Alphabet's scale, is hard to ignore. And it's why many analysts continue to recommend Alphabet as a long-term investment play in AI, even with the market being as choppy as it is. Google's business model continues to show resilience. Whether it's advertising, the rapid deployment of Gemini, their AI large language model, or the growing strength of Google Cloud, the company is diversifying its revenue streams while keeping its core business highly profitable. Now, that's not to say everything is smooth sailing. Alphabet is still dealing with the aftermath of a major antitrust ruling. A U.S. federal court recently decided that Google must open its Android operating system to rival app stores, following a case brought by Epic Games. This could have real implications for its App Store revenue and the broader mobile ecosystem. On top of that, Alphabet lost its appeal, which is only amplifying the pressure. There's also growing competitive heat from Meta, especially in areas like advertising and AI-driven experiences. While Google remains dominant, these challenges have added some caution to investor sentiment. As cloud and subscription revenues continue to grow, the market will have no choice but to re-rate the stock higher, recognizing Alphabet's true value as a diversified tech powerhouse. Getting in now is like buying Microsoft before its cloud boom, a chance to own a leader before the market fully appreciates its next act. Alphabet is an AI powerhouse hiding in plain sight, with unbeatable data, multiple growth engines, and a compelling entry point for long-term investors. For investors seeking a blue-chip way to ride the AI wave, Alphabet stands out as one of the best bets out there, combining stability, innovation, and explosive potential for the future. There you have it, two titans of the AI revolution, both trading at a discount. In a world where artificial intelligence is rapidly transforming every industry, companies like ASML and Alphabet are not just participating, they're leading the charge. Their influence stretches far beyond their own sectors, shaping the very foundation of tomorrow's technology. ASML is the essential hardware provider. Without their cutting-edge lithography machines, the chips that power AI simply wouldn't exist. Every major tech breakthrough, from self-driving cars to advanced robotics, relies on the hardware ASML helps create. Alphabet, on the other hand, is the data-driven AI leader. Their innovations in search, cloud computing, and machine learning are setting the pace for the entire industry, making them a cornerstone of the digital future. Both offer a smart, long-term way to invest in AI's explosive growth. Whether you're drawn to the foundational hardware or the software and data side, these companies provide exposure to the most exciting trends in tech. Their potential for future returns is enormous as AI adoption accelerates worldwide. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. But this isn't just theory. You'll learn how to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments no matter what the market throws at you. Whether you're just starting out or want to sharpen your strategy, this course gives you the tools and confidence to grow real, long-term wealth. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Trust me, your future self will thank you. For exclusive tips, in-depth analysis, and a community of like-minded investors, join the Stocks Galore Patreon community. You'll get access to research, quandus, and more to help you stay ahead of the curve. Now, I want to hear from you. When it comes to investing in AI, do you prefer ASML's picks and shovels approach, supplying the tools for innovation, or Alphabet's data dominance, driving the software and intelligence behind the scenes? Each strategy has its own unique strengths and opportunities. Drop your thoughts in the comments below. I love reading your perspectives and learning about your investment strategies. Don't forget to like, subscribe, and share for more investing insights. Your support helps us bring you even more valuable content on the future of technology and investing.